dive straight into individual names. So straight off the bat, it's more up than down. Some should be 30 plus up and the rest lower. Shriram Finance and HDFC Bank on one end. On the upside, there's Dr. Reddy's, Eternal, and Sun Pharma, which is starting in the green. Reema.
Well, Pharma is right on top. Sectorally, the Nifty Pharma Index is opened with a gain of about 1%. And it's not just Lupin, which is planned, investments in India. Outside of that, you've got a Dr. Reddy's, Sun Pharma, Cipla, all surging. The top gainer today is a Dr. Reddy's, and that's up close to about 1.6%. So Pharma is doing very well. IT continues with its gains from the last 3 days. Now the IT index is up more than 4% from Monday to Thursday as we speak. And again, you are seeing some strength coming through in many of these frontline IT names. HCL Tech seeing buying. For HCL Tech, Infosys, Tech Mahindra, Wipro, the numbers all come next week. Today, it's TCS and Tata Elxsi, and TCS has opened the day with a gain of nearly 0.5%. Eternal is the other gainer on your large cap screen. Citi has raised the target price to 395. They've got a buy call on Eternal. They say the growth momentum in Blinkit remains stellar. And they're saying focus on user acquisition is visible in terms of acceleration in app traffic. And Blinkit's market leadership is further solidified in the recent quarters. For food delivery, they expect things to be stable. So Eternal on investors' buying radar. So Pharma is right on top. IT continues with its upward momentum. Eternal is seeing some strength. And throw in a couple of metal names. So Tata Steel and I think JSW Steel. These are stocks with gains of more than 0.5%. Things are quiet, at least for the Nifty Bank. So it's opened in the red now. The Nifty Banking Index is down nearly 100 odd points. HDFC Bank, it's dragging its feet. So that's putting pressure. Also on the way down is Power Grid, Titan, Tata Motors. Titan was a big mover yesterday. So just pausing after the stellar gain. NTPC, Bajaj Auto, actually quite a bit of auto, and banks too, a little bit in the red.
Well, that's right. I think the stock of the morning is Saatvik Green Energy. The management just joined us a few minutes ago and they were talking about keeping up the momentum, which will effectively mean that 900 crores is what they delivered in the first quarter, with them ramping up capacity. A number of around 3,800 to around 4,000 crores with margins of around 15 to 16% looks gettable, which means it'll be a sharp improvement on a year-on-year basis. So yesterday the stock was up. Today the stock has seen some follow through with another 10% gain. Clearly the stock of the morning. Operational update, you like Prestige Estates, 6.5%. Street reading it very, very positively. And HFCL as well. As stock, in fact, is doing very well in this morning on rather large volumes. So big move is what we're seeing on that name as well. What's coming for some profit taking? McLeod Russell, the stock is up more than 20%, I think, in the last 10 sessions. That one's down a little bit and it's falling on decent volumes as well. So that's coming for some profit taking. Jacob, which saw a big move yesterday, that as well is coming for some profit taking, as is the case with ITI. That's another name that's coming for some profit taking. Anantaraj ended lower because of the QIP, which was priced at a discount, as we normally see. Now, in fact, that stock is bouncing back a little bit, up 1.5%. But the markets, as flat as can be, the Nifty Bank is down 100 points.
Okay, all right. I think we are just kicking off the session. Absolutely flat, right? I mean, even keel. 3-point change on the Nifty. 25,045 is where we are at this point in time. By the way, I don't know if you can pull up some of these silver ETFs, right? Silver Bees is the #1 volume traded ticker coming up on my screen on the NSE. It's up 2.5%. So 155 on Silver Bees. And many of these are jumping up and quite nicely, 3-4%. And there are a bunch which are listed out there, which are doing very, very well. Not these. I mean, you've got to look at the financial instruments. All right, Prestige is up 6%. I think we mentioned all of these. Oro, Lupin, they're all up. Vari is up about 4% as well. There is, it's not a bad-looking screen at all. At least as far as the broader market is concerned. 1,300 up and about 1,040 stocks which are lower at this point in time. The reversals are basically just off what big moves from yesterday. Imco Electronics, 1% lower, was a massive mover yesterday. Salzer, huge volumes, around 5%, was a big mover yesterday. Bluestone was on Hormuz's list earlier today. Big move yesterday, reversing a little bit. And of course, RBL which went up 5%, is down about 1.5% as well. So that's it. Otherwise, it's not a bad-looking screen. Manish Gwani is with us, head of equity at Bandhan AMC. Manish, great to have you with us here. Appreciate your time. You know, we had one. It's like a round trip. Came up to these levels earlier, then came back down. We are back again, knocking at 25,100, 25,200 yesterday. So the question is there enough in the tank for us to move ahead? And this is a time, Manish, where global equities, global markets, etc., are making new all-time highs. Even a geography like Europe, unloved, underowned, breaking out. Other Asian markets, US, of course. What's your sense, Manish?
I think we are going through a fairly healthy correction, just like October 21 to March 23. I think India seems to be a different phase versus emerging markets. We first outperformed, and this year we kind of giving away that outperformance to a certain extent. But I think the structural underpinning of this bull market remains intact, which is what is now being called the debasement trade globally, that most of the developed countries have very high government debt, because of which they are running negative real rates in the case of something like Japan. And I think the broad expectation is US, Europe will kind of follow. We are seeing fiscal deficits remain very high, even when the economies are doing well. So in US, you are seeing a fiscal deficit, which normally shouldn't happen in a normal economy. The debt to GDP of most developed countries is more than 100% to GDP, which is typically a red flag. So I think when you see gold, when you see silver, when you see Bitcoin, I think risk assets have good momentum, because eventually people are reading into the situation that kind of money printing, if you're cynical, that's the phrase, that money printing will eventually happen in US, Europe, and continue to happen in Japan.
So how long, Manish, hi, morning, Rima here, how long will this period of consolidation continue for a market? It's been over a year. Does it extend, say, for 6 more months till a tariff comes and then we have a tactical bounce? Because there are some comparisons, I mean, not comparison, it's not the right word, but, some have also referred to India's lost decade. And at that time, the returns, the CAGR returns were very, very modest, low single digits. I mean, is there a possibility that this consolidation just extends for 2, 3, 4 years?
I doubt it, because, as I said, the structural underpinning of this bull market is very loose monetary policy by most of the developed countries where most of the capital markets and economic growth resides. So I do think that, if you see the last 3-5 year returns of large cap, but more in the mid and small cap space, most of the funds have done, 20-30% CAGR. We can't be that greedy that we expect every year those kind of returns will continue. So to me, this is just that kind of consolidation phase. How long it will last, I think market timing obviously very difficult, but I do think difficult to expect very big returns over next 1 or 2 quarters, not because of anything fundamental. It's just that the supply of paper is so high that it is very difficult to absorb that supply and still create big return. That is my gut feel. But from a 3-5 year perspective, I am very confident that we will have, I think the large cap may do something close to nominal GDP, but I do think a good stock picking fund should be able to deliver materially above that, because I do think liquidity will be healthy. And when liquidity is healthy, the broader market tends to outperform the large cap index. So I am not of this secular stagnation kind of view for India. I just think that we made excess returns from 2023 and 24 calendar years. And we're kind of having to live with a bit of low return for 1 to 1.5 years, and then we will have the structural uptrend continuing.
All right. Hi, Manish. Good to see you. I recall in one of our conversations, you were talking about there's a decent risk reward on metals. And China as well, you were calling out probably that, they're based out and things could recover. Both those two have worked. The Chinese markets have actually outperformed the Indian markets in the last 1 year or so. And metals have held their ground, even amidst the market volatility. What's your view from your on? Do you think there is still value with regard to metals? China seems to be going for that anti-involution, which in turn will make them reduce production. And India's got their safeguard duties to protect the domestic industry. Bodes well or bulk in the price?
Yeah, I'm quite positive on metals, although you have to be a bit nimble around this sector because things change very fast. But two, three things, right? I mean, first is, as I said, the structural underpinning of this market is liquidity creation by monetary policy. And if dollar weakens, for example, it typically helps all commodities. So if you divide metals into non-ferrous and ferrous, I think ferrous is more a protection trade versus the anti-involution trade, as you said. That's a different trade. I like more the non-ferrous part because if you see aluminum, most of a big cost is electricity. And we all know globally electricity is in short supply given the AI capex that is happening. So even though I don't think global growth is going to be great, I don't think China is ever going to grow back at the way it used to. So I'm not so bullish on global growth, which is typically one reason to buy commodities. But I think the monetary printing of money, along with the fact that some of the cost push in these commodities is going to be healthy. And finally, look, I mean, you can only buy gold till a certain level. I think that liquidity will go to commodities and equities finally.
Yeah. Point taken. By the way, the market's picked up, right? 55 points, 60 points, 25,100 is back on the table after yesterday's sell-off. Manish, I was just looking at, we were talking about, you said debasement trade, right? And it's absolutely right. It's just, we all I think post GFC, gold was supposed to do this and that, and there were so many views, and they were all right. It's just that maybe they were just ahead of the calls were, and you can never time these things, right?
Yeah.
But it was always clear for 15 years, but I guess no one believed it because, and when prices move, then you start to believe it, as it is with so many things. But what's the view now, Manish? I mean, I know you're an equity man, but if I were to ask you to comment, I'm specifically on gold and silver prices from here.
No, I think you should have it in the portfolio. My view is that in this debasement trade, there are various risk assets, right? You have gold, silver, you have Bitcoin, you have emerging market equities, you have Indian equities. I think you should just own a basket of everything because nothing is cheap. Everything has done well in the last 3-4 years broadly. But the simple point is that we've not seen government debt to GDP at a global level at this level. Like more than 100% is the norm now. And you see a place like Japan, the new prime minister is still talking of tax cuts and fiscal aggression. It's quite ridiculous to my mind. How much money can you print? But that is the way things are going. And in a weird way, it is risky not to be risky in that sense for asset allocation. So I do think you should have some proportion of gold, silver. Now, obviously, how much of equity, how much of gold, how much of silver is everyone's risk profile fit. But I think you should have, although it's done well, but it is when you see the fundamentals of the kind of money printing that needs to happen to service this government debt, we should have some hedge against that.
At an AMC level, you all have been anchor investors in many of these recent IPOs. I think LG Electronics also, I saw your name. Before that, Urban Company, that was a big one. And even in some of the smaller ones, like a Pace Digitech or an Anand Rathi. So participating in, across the board, what is your view on what we're seeing in the IPO market?
So we don't have a black or white view saying IPOs are bad or IPOs are good. I think we evaluate each IPO on its own merit. And obviously, we also have different fund managers have different thought process. We don't believe in having one thought process across the house. So we look at each IPO on its own merit, and we just, based on fund manager view, if we like it fundamentally, we don't really worry about whether it's IPO or not. We just see it as another stock to consider. So yeah, we're pretty open to new ideas in that sense.
No, absolutely. New ideas in that sense. One other thing which is done very well. Actually, money's gone into two things. We were talking about precious commodities. The other one, it is into U.S. stocks, and in U.S. stocks, it's gone into all these new themes, newer themes. AI and data centers, and now, of course, things like quantum, etc., nuclear. Very little by way of plays here, right, Manish? You've looked. Have you found any?
Yeah, I think there are a couple of plays on data sovereignty and hyperscaler exposure, not very big. But yes, I think we should put in effort to see how that wave is going to impact India. Honestly, I do worry about AI, the kind of job impact it will have. No one knows what's going to happen for sure, but there are some who believe that the job losses will be very acute before new jobs get created. See, typically any new technology, when it comes, people get scared about job losses, but eventually the net job creation is positive because it creates different types of jobs. Now with AI, given the scale of this technology, there are fears that the job losses will first be so acute that it will impact countries like India. I do worry about that. It's a tail risk to my mind. I still believe generally technology is good for job creation, but you have to keep your mind open, right? I mean, we don't know how it will play out. But yes, on the positive side, if you want to play this AI capex, the data center capex, I think, again, it won't be available in the large cap space. Most of it is available in the small cap space. But yeah, there are a few plays out there.
Just for, if you can point us in the right direction, Manish.
I will not be.
No, not as a this thing to buy, but I mean something you've looked at, and of course, make it clear that people should consult their financial advisors, do their own research, etc., before they do anything. But in that sense,
so, Prashant, I feel that when an economy goes from 500 billion to let's say 4 trillion, you can afford not to be in high tech. But if we aspire to go from 4 trillion to 10 trillion, we need to own some tech ourselves. So we will need a bit of protection or let's say sovereignty around some of these technologies. You must be following that, for example, one of the enterprise software suites the government is pushing very hard. With the same logic, I do think that when we are hosting data with these global hyperscalers like AWS, Google Cloud, etc., there is a bit of risk you're taking, right? I mean, because ultimately, even if the data center is in India, but it's a US corporate, that data is in one sense available to the US government if they want it. Now, that kind of, for 95% of data, that won't matter. But for 5% of data, like defense or academics and all, I think that will obviously be an issue. And then the only way out then is to create some domestic champions in hyperscalers. And I think, see, nothing is sure, but that is a hypothesis we have. So I think it's good to have some exposure to those kind of plays.
Manish, one word answer since we're out of time. And this is for those who want to, invest in a thematic or a sectoral, and, a fund, for instance. Which is the sector you're most bullish on, and which sector will you avoid completely?
So I like this theme called these innovation funds, which have come up recently because, to put it in a nutshell, these are the Nasdaq equivalents of the US markets. And we see that over 30, 40 years, the Nasdaq has obviously outperformed S&P 500. Because as the economy develops, the knowledge-based sectors become larger and larger part of the ecosystem. So I do think innovation is a good theme to look at.
Yeah, absolutely. That covers a fair bit, right? I hope that fund will touch upon and do some of what we're talking about, maybe a better way to get exposure. Thank you very much for joining us, Manish. Appreciate your time here on CNBC. All right, we'll talk about Senco Gold. Mangalam is standing by. I think there was that second quarter update. Mangalam, over to you.
Stock is lower in today's trading session, lower by about 2.5%, because the street is clearly disappointed after seeing what Titan has done, after seeing what Kalyan has done. Street was thinking that maybe on a lower base and because of its higher exposure to West Bengal, where the festive season started earlier, they would do a lot better. But turns out, no, it's 6.5% growth that the company has reported, and that the company attributes to higher gold prices, a very high base, and unseasonal or, high rains along with flood-like conditions in parts of Kolkata and West Bengal to the weakness in their overall performance. And that's something that the street is disappointed by. Though for them as well, because of higher gold prices, diamonds have grown at around 12% in terms of value. But remember, that accounts for a lot smaller share in their overall portfolio as compared to, say, someone like a Kalyan or Titan. Importantly, they've added about 5 stores, and they are sanguine about the next couple of quarters, where they believe that they can go ahead and do about 18 to 20% growth, which is not a big material uptick from the first half of this year, where the company has grown about 17.8%. So to that extent, management commentary on outperformance beyond what it's already reported would be crucial, especially at a time when the larger peers are doing a lot better.
Thank you very much for that. Let's go across now to Ria for Lupin.
Well, yes, Lupin is around 3% higher after they've announced plans to build a manufacturing facility in Florida in the US. Now, the company has said that this project reflects the company's long-standing commitment to US patients and the healthcare system as well. And the new site is going to expand their US-based pharmaceutical company to produce critical respiratory medicines. Now, Lupin is going to invest around $250 million as a part of this investment over the next 5 years. And this investment will be on 5 acres of land. And further, they've also said that the facility will have the capacity to produce over 25 key respiratory drugs, including albuterol inhalers for asthma patients. Now, this initiative, the company has said, aims to strengthen domestic manufacturing, diversify their supply chains, as well as enhance medicine security. And the project is also expected to create more than 200 long-term skill jobs in the region by 2030. And lastly, they've also said that Lupin is going to receive tax incentives from the state of Florida for this. And on the back of this, the stock is higher by around 3%.
Okay, all right. Lupin, 3.5% higher. Ria, thank you very much for that. Well, we're talking about, precious metals, gold, silver with equity people. So let's talk about precious metals with precious metals people. And our next discussion is exactly that. Varghese Alukas is Managing Director at Joyce Alukas. And we have Dilip Narayanan, Head Treasury and Banking at Malabar Group of Companies. Gentlemen, great to have both of you here. Appreciate your time, gentlemen. Prashant, this side. Mr. Alukas, if we can start with you, with this absolutely stunning move in gold prices internationally and here, naturally, could you give us a sense now, because the quarter has ended, all right, and that's the big 3 talking points which are coming up on your screen right now. But the thrust basically is this, Mr. Alukas.
Yeah,
gold jewelry. Are people buying gold jewelry at these very high prices? And if you can give us a sense of what the second quarter number, that is September ended quarter, looks like.
Yeah, good morning. So we are feeling the higher price of the gold price from last 6 months. Even today, the gold price has been a record selling price around 11,380 rupees per gram for 22 karat jewelry. And last 2 weeks, we see that there is, due to the festival season and the Diwali sales which is going to come up, and then the Dasara and Gandhi Jayanti holidays, there have been uplift in buying from the customers who have been coming to the jewelry, and the sentiment is high that if the gold prices keep on going up, people are now coming back to jewelry to buy the jewelry. And last quarter, we have been recorded at 20% higher in the sales. So coming month is the Dhanteras and Diwali season, which Indian customers always buy jewelry, and it's a sentiment that every Indian household buy jewelry, not only as a style statement, even in as the investment they buy. So we are seeing a good sentiment to buy more jewelry in coming Diwali days.
Mr. Alukas, sorry, you're saying July to September has seen 20% growth in sales.
Yeah, in the sales.
Right. That is
higher gold prices.
Right. That is value-wise, right? Value-wise.
Value-wise. And in volume-wise, both are, most of them are having a dip in 20% in same way.
Dip of 20.
Yeah.
So volumes are down 20%, and the value is up 20%.
Yeah.
That's a nice, neat headline you've given us, Mr.
Because the volume has gone down.
Yeah, obviously, because, I mean,
it's the revenue and the higher prices.
Yes. Mr. Narayanan, come in here. Is that your experience as well?
Well, first of all, thank you for calling me for this interesting discussion. Mr. Varghese is kind of right on what he's mentioning, but I can see, I was mentioning about this demand a couple of weeks before, at least 3-4 weeks before in one of our panel discussions, that the pent-up demand, which the customers had not been buying for some time, has started now. There is panic buying also happening. There is festive season buying happening. There is also a sentimental fear which has gone into the customer. That buying is also happening. So fundamentals are all kept aside, and it's all now sentimental. And then that is this kind of buying pressure we've not been seeing for some time now. And globally, it's not only in India. Globally, there is huge demand. The sovereign countries, the central banks are purchasing. Each and every country, reserves are going up in gold. So yeah, this is the right time to be to invest in gold. And as I always mention, the trust on gold is increasing day by day.
Mr. Narayanan, just sorry, you said you used the word panic buying.
The reason why I mentioned that word is because there is market the market saying that the price would still go up more, and then you would see around 5,000 levels touching, which is technically technical analysis also has their own reasons to say that. Personally, if you ask me, it's completely my personal my personal opinion on the yellow metal is that it is on a bull run, and I won't be surprised that if it again jumps another $200-300 from here while we speak, and we're going to definitely see a good run. There is business. Apart from that, very interesting part is that investment bars are also been now in good demand, which is not normally. It takes the back seat in India as compared to any other country. But now you can see the investment bars also performing well.
My next question is actually what kind of value growth will we see over the next 2 to 3 years? Mr. Varghese, as you said, right, so far value growth of 20% is sustaining because of the surge in the price of gold. Now laying out a scenario, say in the next 2 years, gold prices don't go up. It's hard to imagine gold prices going up 40% every year. If they stay at these elevated levels and volumes continue to remain muted, it's hard to imagine people, spending so much with gold prices at, 1,24,000 for 10 grams of gold. What could be the kind of value growth? Can you sustain then value growth of 20%, say 2 to 3 years? What are you internally working with? Mr. Varghese?
Yeah. So, as we said, the gold price has been in record levels, as Mr. Narayan said. From the 4,000 levels, it may again go up to 5,000 levels, is what the market say. So, in that case, the value of gold price will be seen in the revenue, where there can be again 5 to 10% increase in this case of gold price going up. But we see the volumes are a little bit going down, but now most of the jewelry have been made in a lighter way and in a different way of price-centric. So we still feel that the sales can be brought up with the lighter weight jewelry to make up the level of the revenue we have. But the gold price, again, if it is increased, we again can say 5 to 10% can be increased, but we don't know where the prices, because every 1 or 2 months, it may still go up to 5,000 levels. So maybe 5 to 10% again can be increased in 2-3 years.
All right, it makes the inventory hedging, question very, very relevant then. Mr. Alukas, how are you all managing that? What proportion of your sales are hedged?
So we have been buying in a fixed way, like as we are a private company. So we buy on spot, and we see last 4-5 years where the gold price was in 2000 levels, which has come up to 4,000, 4,035. So all the inventory prices have been going up for last 3-4 years. So we are really seeing the profit percentage and a higher valuation in our books.
Dilip, same question to you. Do you think, at a company level, the industry level, may need to, let's assume gold prices don't go up to 5,000, right? If they just stay as it is, what would be the volume growth that you anticipate going forward once this festive season comes to an end? It's already down 20%, but going forward, what would the what would the sales look like, assuming gold prices stay where they are, and therefore the value growth for the industry for the next 2 years?
I think it would remain the same at around 10 to 15%. And the reason why I'm telling this again is that I would repeat my same statement that this demand is not seen for many years. This kind of demand, this doesn't look like a festive season demand. It is also people gathering gold as a safe haven. So and this if price keeps going up, surging up, the demand will keep coming up again and again, and you might end up with a very good sale for this entire financial year.
Mr. Narayan, when you say this does not look like festive sales, you're talking about feedback from customers, retail, normal people.
The normal people are buying. So again, I'm telling you that apart from normal people, there are investors who got into the market. So that is a sign of real demand which is coming into gold, or I would say that added trust which is coming into gold,
Got it.
which was anyways there.
Yeah. Let me ask you this, as Mr. Alukas also told us, volume is down 20%, right? So,
yeah.
Mr. Narayan, what percentage of your this move that we've seen? Gold prices were $3,000 in March this year; they're now $4,000, right? What percentage of this move is investment led in India? I'm saying not globally, but what you're seeing at your end. You said demand for bars, etc., is also rising. It's too early to calculate a percentage of the growth which is roughly there in investment bar as of now. But definitely from what it was earlier, there is a jump of almost 5 to 10% at this point of time. But then you have to wait and see how the numbers increase as the days pass by, because now Dhanteras is is the upcoming festive, and then the Diwali, and then there are a lot other festivals also. There is a year-end Christmas coming up, so you might have to wait for another 1 month or two to see how this investment bar demand, whether it's going to sustain or not. But for the kind of purchase which is happening, it looks like that this is going to sustain. And for Malabar as well, volumes are down 20% approximately in the ballpark in Q2?
I would not want to comment on that, because I would check on the numbers before I would comment.
Okay. Mr. Varghese, would you have a number? What percentage, according to you, if you have to estimate, would come for investment purposes? Any number?
We're not still taking the numbers as of now.
Sure. All right. And do we know the rate at which the unorganized market has grown? If organized has grown 20% value-wise, unorganized would be at?
Yes, organized retail are been coming up in the Indian industry. Most of the jewelers are coming to the now organized way.
Okay. All right, gentlemen, appreciate you joining in. Thanks a lot for giving us your take. And it spells good times, I think, for all gold buyers. So wishing you all a good festive season as well. For the timing, we slip into a short break. On the other side of the break, we'll have the management of Rubicon Research, whose IPO opens today. We'll have Mr. Parag Sancheti, who will be joining in. Welcome back, Phil. The markets have flattened out a little bit. We had danced way closer to around the 25,100 odd mark, but now from the top, we've seen some kind of profit taking. The good news, though, is that the breadth of the market is still in favor of the number of stocks that are advancing. So that's good news. But let's focus on the new IPO. Pharmaceuticals company Rubicon Research's 1,377 crore rupee IPO opens today. It comprises of a mix of fresh issue of equity shares that's worth around 500 crores and an offer for sale of around 878 crore rupees. We're now joined by Mr. Parag Sancheti, the Executive Director and CEO at Rubicon Research. Hi, Mr. Sancheti. Good morning. Thanks a lot for joining in and welcome to the stock markets. Well, let's get a couple of details out of the way first. If I look at your issue, there's around 500 crores of fresh issue. And that will be used to repay a debt, I think, in the vicinity of around 300 crores or thereabouts. So just confirm that number. What will this money be used for? And in terms of debt repayment, could you quantify the interest savings?
Yeah, so thanks for having me on the show. And obviously, indeed, exciting times for the company as we go public. The 500 crores which we are raising is primary, would be going primarily towards debt repayment and then partially towards inorganic growth opportunities. We currently, if you look at the debt is around 400 crores plus in the books. So, you could, considering estimate, we don't want to guide exactly to the number, but I think we are repaying around 300 crores of debt. So that would be the kind of interest rate savings which will be following through to the bottom line.
So you become debt-free post this?
We'll have debt for the working capital, but otherwise majority of the debt will be.
Back of an envelope calculation would say 310 crores, approximately 10% saving. So, that should be in the vicinity of around 32 crores or thereabouts. That would be a fair estimate, right, of interest saving?
Yeah.
All right. And the inorganic growth that you're talking about, that will be, in the vicinity of around 150 to 190 crores, the amount you'll want to spend?
Yes.
And typically in your business, what kind of sales, if I look at the sales upon market cap, what should be the rough estimate? If you're looking at an acquisition size, say, of around 150 crores, what should the revenue potential of that company be? A very rough estimate for your industry.
Yeah, so I wouldn't do it because if you see the history of Rubicon, I think we've never done acquisition just for the size or the revenue of the company. So we've done 5 acquisitions in the last 5 years, and all of them we have kind of done it for the capability. So I wouldn't say the sales is a good proxy or how we are going to look at doing inorganic stuff. We'll follow the same discipline we've been following to get capabilities and then bolt on that. And that has kind of disproportionately paid for us in the last 4 or 5 years.
Got that. So that explains how you're planning to utilize all the funds that you're raising via the IPO, the fresh issue for the acquisitions and paring down the debt. Parag, morning, this is Rima here. Just give us a quick overview about the company. How are you different from the other players? And also, almost 97% of your revenues, are exported to the US. Are you going to be impacted by this 100% tariff on branded and patented pharmaceuticals, imports on that starting 1st of October?
Okay. So I'll just give you some brief of the company and then I'll dive into the question on the tariffs and how we look at the US business. So I think we're a very fast-growing specialty pharmaceutical company with a portfolio of products that includes both specialty and drug device combinations. We have 3 manufacturing sites in India. We have 2 R&D sites, one here in India and one in Canada. If you look at, I think, just the key business highlights for us has been, I think we've been the fastest growing Indian pharmaceutical company as compared to 6 Indian and 4 globally listed peers by Frost & Sullivan. R&D is a big focus, and R&D focus coupled with the amount of money we spend more than average of the industry on R&D, I think has led to a very, very robust pipeline of products coming in. If you look at, as on 30th June, we had 16 specialty products which have no competition or max 1 competition. We have 4 drug device combination products which are approved in the US. So I think this, if you just look at these highlights, talk about the R&D, product selection, and our execution rigor, which we have built the company with. So if you look at, as compared to any of our other competitors, you look at all our metrics like commercialization rate, 86%, our ROE around 29%, ROC around 26%.
Yeah, Parag, we have those numbers are there. Morning, Prashant here. What is when you say specialty? What are specialty products? How do you define them?
So we define it in a very, very economic term when I think people have struggled to put it as dosage form. So we say if we have one or less competitor for at least 1 year from the time we launch, we call that a specialty because that gives us pricing power and sustainability of the pricing power.
Are you, is the way you operate, is that like a CDMO, a CRDMO?
No. We are a product development company with our own front-end marketing in the US. We sell both generics and branded products.
So it's not as if big companies come to you and say, well, we want you to make this or...
No.
Okay.
We are end-to-end product development, manufacturing and selling company.
And all of this, all of the manufacturing happens in India?
Some majority happens in India, but we do also have CMO sites in Europe and the US.
Are you planning to expand your footprint to the US? And just to complete that point about any impact from the Trump tariffs.
So I think the generics I would not touch base because that's, I think, quite a settled matter.
For you?
For us. And if we come to, I think the branded, we have 3 branded products in the United States. One which gets manufactured in the US, 2 we manufacture here and send it. Obviously, we have already built-in plans which are there mitigated to ensure that there's not going to be no impact on the tariffs on those products too.
Okay, all right, Parag, help us out with a couple of other factors. If I look at your margins, they have improved from early teens, that's around 10-11%, to close to around 20%, in the last few years. I know that you will not give us a fixed guidance, but the margins that you're doing, is it sustainable? Point number 1. And point number 2 is on pricing. The industry on the whole has seen pricing erosion to the tune of roughly 6 to around 8%. However, you have gone ahead and you have managed to take price hikes as well. So please explain this to us, margins and pricing.
Yeah, so I'll first explain the price hike part of it. I think it's not price hike. I think what the Frost & Sullivan report says is how is our portfolio comparing across the industry versus the other portfolio, other listed or unlisted companies who are operating in the US. In that case, the way our strategy on sales has been, I think for the same portfolio of products, what prices we had in 2022 in 2025, we have seen an 8%, as per Frost & Sullivan, we have seen an 8% appreciation, whereas the industry has seen around a 5% depreciation on the pricing. So I think that talks about the way we have selected the products and how we execute market share or sales strategy in the United States. Now coming, I think, margins part of it, I think the margins definitely will sustain at the levels which are there, which if you look at our history in the 23-24, obviously we've spent disproportionately on R&D to ensure that we have a very, very robust product pipeline, which allows us to kind of build a very, very solid business in the United States and other parts of the world. So I think that owing to very high R&D spend, I think we've been able to, we've kind of by design had margins which were lesser. But I think the margins which you're seeing right now is something which will definitely sustain and will improve. We have more levers to improve that beyond that also.
All right. Prashant, I briefly asked you about specialty. How do you define it? What is the specialty contribution as a percentage of your mix? If you could help us out with that.
The matrix we give track for that is, I think, as of 30th June, 33% of our gross profit came from specialty, which constituted 16 products currently.
And as a percentage of sales?
No, we don't give that, but I think you can see the margin profile for the company and kind of back calculate on that.
Okay, all right, Parag, you've given us a sense in terms of the business. We'll want to understand more. It looks like an interesting business. Wish you well with the IPO, and we look forward to chatting up with you on the listing as well. Thanks a lot for joining in.
Thanks a lot. Thanks for having me on the show.
All right, and as we were having that discussion with Parag, the markets actually have moved to the low point of the day. So that entire bounce that we saw, that's got sold into. And now the Nifty trading mildly in the red. Slip into a short break. A good time for a technical check. Shilpa Raut or Prabhudas Radad will be joining in.
Welcome back. For the markets, it's flattish. The Nifty is at 25,050, but we've come off in the last 1 hour. Shilpa Raut, Senior Analyst Derivative at Prabhudas Leeladhar, is now joining in. Shilpa, your thoughts on the first hour?
Good morning, Nigel, Prashant and Reema, and thank you for having me on the show. Talking about the indices sector, we know that there's a resistance at around 25,150 to 25,200 on immediate basis, and support also lies at 25,000 mark. So any declines towards 25,000 should be levels to buy. Keep a stop loss of 24,950 and stay long. Talking about Bank Nifty, any declines towards 55,700 to 500 zone should be a buying opportunity, and one can again expect 56,300 levels for Bank Nifty.
Okay, all right. Hi, Shilpa. Always good to have you on the show. What about individual stocks? What's on your radar?
Nigel, I have two buys. The first one would be a buy in Max Health. Pharma sector is doing good, and Max Health has a good support at around 1130 zones. So that should be a stop loss, and look for targets of 1180 to 1200 levels. The other one would be a buy in BSC. Again, the capital market stocks are doing good. M6, BSC, they're all looking good. But BSC has a good support at 2220 zones. So that should be the stop loss, and look for targets of 2300 zones and above for intraday basis.
Oh, thank you very much for that. Let's talk about stock sectors. Vivek is now joining in. Vivek, on Pharma.
That's right. Well, that's right. You know, the Nifty Pharma Index is one of the top gainers today, and all of the generic Indian pharma companies are the ones that are doing quite well. Most of the stocks are up anywhere between 2 to 5%. Names like Zydus, Lupin, Aurobindo, Dr. Reddy, all of these names. So what has actually transpired overnight is that, remember, Indian pharma, especially the generic names, were suffering from an overhang, given the fact that there were various reports coming in from the USA saying that generic pharmaceuticals may be under the umbrella of Section 232 of tariff imposition. However, what WSJ, which is the Wall Street, has reported overnight is that they are saying that Donald Trump may spare imported generic pharma products from tariffs. In fact, they have quoted the White House spokesperson Kush Patel, and he has said that the administration is not actively discussing imposition of Section 232 tariffs against generic pharmaceuticals. Now, WSJ has gone ahead and further said that the decision not to impose tariffs on generics represents a major scale back of Commerce Department's investigations into pharmaceuticals. They also say that, and they've quoted an earlier Federal Register notice saying that the investigation would target both generic as well as non-generic drug products. Given the fact that this particular overhang, at least for the time being, appears to have lifted, all of the pharma stocks today are doing quite well in the session.
Okay, thanks very much, Vivek, for that. So pharma, perhaps flavor of the day today, 3.5%, 4%, Aurobindo there as well. Well, on to our CNBC-TV18 exclusive. Exactly a year after Noel Tata took charge as Tata Trusts chairman, a fresh power battle has erupted involving key trustees. With government intervention underway, hopes are rising for a resolution in this high-stakes corporate clash. My colleague Shireen Bhan filed this report.
There is a fresh battle brewing at the House of Tatas. Now, the rift has now reached the corridors of power in New Delhi. CNBC-TV18 has accessed both sides of the story. Last night, Noel Tata, the chairman of Tata Trusts, N. Chandrasekaran, the chairman of Tata Sons, met with Home Minister Amit Shah and Finance Minister Nirmala Sitharaman in New Delhi. Tata Trust trustees Venu Srinivasan and Darius Khambata were also part of that meeting. Interestingly, Khambata is being accused of being part of the quartet of trustees allegedly trying to undermine Noel Tata. Now, this latest power struggle comes nearly a decade after that bitter public battle between the late Ratan Tata and the late Cyrus Mistry. Now, sources close to Noel Tata claim that there is a coup attempt by 4 trustees. Here are the trustees: Darius Khambata, Jayat Jahangir, Pramit Javeri and Meli Mistry. Now, sources close to Noel Tata allege that these trustees tried to emasculate the leadership of Noel Tata and wanted to function, quote-unquote, as a super board. But sources close to the Mistry quartet deny these allegations. They claim that the coup narrative is false and there is no attempt to usurp powers. The Mistry camp claims a false narrative is being painted to make them look look, quote-unquote, like villains. According to sources, there are three key flashpoints that have triggered the current escalation of tensions. First is the fund infusion into Tata International. Now, Noel Tata is the chairman of Tata International, and an equity infusion was proposed to help tide over the losses in the company. The company is also saddled with a debt of around 2,000 crore rupees. Eventually, the infusion of 1,000 crore rupees by Tata Sons was cleared, but sources say that the matter, quote-unquote, remains unresolved. Now, another flashpoint is Noel Tata's idea to create a position of a deputy MD at Tata Sons. Sources close to the Mistry quarter say that the proposal also created differences of opinion between the Noel Tata group and the Mistry quartet. And the third point of contention has to do with Mehli Mistry's appointment to the board of Tata Sons. Now, Mistry, a long-time associate of Ratan Tata, his appointment was opposed by Noel Tata, and sources say this also led to a further worsening of the relationships within the trustees. Now, sources tell us that all four trustees who are today being accused of acting against Noel Tata had in fact voted in favour of Noel Tata's appointment as chairman just last year. Remember, Noel Tata took charge exactly a year ago on the 10th of October after the demise of Ratan Tata. It must also be noted that the upcoming board meeting on the 10th of October is not going to consider any of these issues at hand. That meeting, we learn, is about the philanthropic activities of the trust, which is really at the heart of what the Tata Trusts do. So 1,000 crore rupees worth of philanthropic activities on the agenda on the October 10th board meeting, nothing to do with this current battle. Now, with the government getting involved, there are hopes of a de-escalation, and both sides will try, that's the hope, and arrive at some sort of a rapprochement to bring the public feud to an end. But we will have to wait to see.
Okay, there's some visuals, of course, also coming in. Prime Minister Modi meeting UK Prime Minister Keir Starmer in Mumbai. I think those visuals are coming in from, should be the Raj Bhavan in Mumbai earlier today. Both leaders, of course, meeting for the third time, actually, since Starmer became the Prime Minister in July of 2024. The first two meetings, of course, were held in the United Kingdom. So we'll see what this kind of sort of leads to. Prime Minister Starmer is on a 2-day trip to India. I think they will, of course, also be, after this, at the Global FinTech Fest, where Prime Minister Modi is expected to make a speech at about 1 o'clock this afternoon as well. So there is, of course, talks also taking place as far as the India-UK CEO Forum goes, and then maybe, discussions at the Global FinTech Fest, which is underway. Today is the last day, third day of that event, which is happening in BKC. So important partnership. And as I said, a third meeting since Prime Minister Starmer took over. Of course, those are visuals. More later. Well, just to sort of continue with that story as far as the Tata Group is concerned, 8 years ago in an interview to CNBC-TV18, the late Ratan Tata spoke about the role played by Tata Trusts in the functioning of the Tata Group. He was speaking with Suhail Seth on why the trust structure was created in the first place. We're going to play that out for you.
Mr. J.R.D. Tata often used to refer to Tatas as being the trustees of the people. The Tata family could have become tremendously wealthy by having distributorships, partnerships, etc. in the businesses. But most of the businesses, whether it was steel, whether it was power, or institutions, were set up as institutions for the country. So Jamshedji Tata could just as well have dedicated Tata Steel to the nation or dedicated Tata Power to the nation. They belong to the shareholders and to the people. Personal ownership and personal wealth happened when it happened, but was never the criteria for these companies to be established. So it was natural that he did leave his ownership to his two sons, and then his two sons, who had no children, left them in charitable trusts, as beneficiaries of the companies that they held. So it was a refreshing change that gave way to ownership in an industry not being for the beneficial interest of A or B or C, but for the better good of humanity.
Okay, let's just take a quick commercial break here. We're going to be joined on the other side by Harsh Vardhan, Senior Advisor at Bain & Company, and Anil Gupta, Senior Vice President and Co-Group Head, Financial Sector Ratings. At ICRA, we talk about, the RBI measures to unshackle the banking system. Stay tuned. Welcome back. Let's talk about the banking space now. Two circulars from the Reserve Bank of India. On one, of course, on the expected credit loss provisioning norms effective FY28. The second one, of course, risk weight modification across asset classes. Let's take this forward with two experts in the field. Harsh Vardhan, a Senior Advisor at Bain & Company. Anil Gupta, Senior Vice President and Co-Group Head, Financial Sector Ratings at ICRA. Gentlemen, great to have both of you here. Harsh, good to have you back with us. We spoke that Friday, of course, on the day of the RBI, the MPC, that afternoon. So let's just take it one by one. On the ECL provisioning norms, the circular which has come through, it's gradual implementation, right? So negligible impact on capital ratios?
Yeah, for now. And I think even when the first discussion paper came on ECL a few years ago, RBI had clearly indicated that there will be a smooth glide path. Remember, this is not an incremental change. This is a paradigm shift. This is a very, very fundamental change, and I think the RBI is doing the right way, because if you do it in a jerky manner, then there would be a capital shock. So what effectively RBI is doing in the way it has approached it is to smoothen the impact on capital and on earning to be spread over a few years, so that the movement for the banks is going to be smoother. So that's how I see it.
Some upfront earnings impact, Harsh?
It will vary across banks, Prashant, and it depends really on what the current status of banks in terms of their standard asset provisioning. So there may be some impact on some banks, but there will be some banks on which there will be negligible impact. So this would vary somewhat across the banking sector, but I would say overall on impact on the banking sector, the way these norms have been described and the way the transition has been described would be somewhat muted.
Got that. Anil, your first thoughts on the ECL circular?
So our thoughts are basically no negative surprises. What we were more concerned was basically the floor or the regulatory floor, which will possibly come on stage 1, stage 2, and stage 3 assets. Will the regulatory floor be maybe a higher number, which could entail higher transition provisions? So largely the floors are not maybe something like prohibitive. They are maybe comfortable level, while they will still have an impact on the reported capital ratios, but the floor is okay. For example, like say the stage 1 floor has been kept at maybe 0.25 to 0.4% for most of the retail loans and maybe secured loans. So that is something which is a positive or no negative surprise, because banks generally have this 0.4% on the standard assets. Even for the stage 2, I think 5% or maybe 1.5% on home loans is fine, not a high number. Otherwise, it would have kicked in a higher ECL requirement.
So I mean, and ratings is a key criteria for all of this. No sort of extreme risks for corporates in the medium term.
So for the corporates, I think the proposed changes in the risk weight, which will be applicable, right, for the various rating categories, that will only be beneficial. So maybe in terms of provisioning because of ECL, no negative thing again. But from the risk weight perspective, that changes are beneficial because, let's say, even a AA rated loan will have a 20% risk weight as against 30% earlier, or a BBB rated loan will have a 75% risk weight as against 100% earlier. So it's beneficial for corporates.
On stage 3 to stage 2, and then after 60 days moving to stage 1, what's the current behavior like? Any sense on how many borrowers kind of fall back into NPAs again?
So the rollback rates will depend on the asset classes. Generally, we don't find too many corporate loans as of now in the stage 2 bucket. So maybe SMA 1 and SMA 2, which will be classified as stage 2 now. If you look at most of the banks, typically the stage 2 for corporate loans will be in the range of 0.2, 0.3%. Largely today, that stage 2 is more constituted by the retail loans, where the ECL provision will kick in. That could be a number anywhere between 2 to 5% across maybe banks of their loan book.
Got it. Anil, how are credit costs going to move according to you? Will there be some impact? Private versus PSU?
So credit cost in terms of maybe, see, what we can look at is we are there is FY26 and FY27. Banks can choose to make some kind of a provision, floating provision, contingent provision in a run up to the implementation on 1st April 2027.
Okay.
So one, you can either create those provisions and not have a one-time impact on your capital ratio on 1st April 2027. Or you can build up your capital and take a one-time knock on 1st April 2027. So one-time knock means maybe on a without any forbearance. So we do think that some banks will maybe create a provision in a run-up to 1st April 27, which could have some impact on the credit cost. But again, largely they have strong P&L which can take care of that floating provisions, contingent provisions. But maybe on 1st April, it will be a balance sheet entry most likely, where whatever is the ECL transition provision, that will be basically removed from your net worth or your core equity capital, rather than have an impact on a PNL, one-time impact on the PNL.
Okay. Harsh, on risk weights, right? What? So there's residential mortgages, as Anil mentioned, BBB rated corporates, commercial real estate. What stands out to you?
Yeah, so two areas. One is residential mortgages, but also MSMEs, where the definition has been widened. MSME that will be treated under retail category to group revenue of 500 crore. So those are the major ones. The BBB going to 75 is interesting because a large percentage of our Indian banking sector portfolio is in BBB. And I think that would actually have an impact on bringing down cost of credit to a large, sizable amount of companies if banks decide to pass that on, the lower capital requirement. But can I make a couple of comments on the previous point on the floor?
Sure. Go ahead, Harsh.
The floor is the important. See, look, the biggest change is going to happen in stage 2 because that's where the provisioning floor is 5%. And that is what varies across banks. You know, how much do you have in stage 2, sorry. My own view, Prashant, is that the stage 1 floor especially are a bit lower than what I would have expected. Essentially, RBI has kept it at where the current standard asset provisioning is, which means, although I don't think, given the general spread of portfolio of Indian banks, 0.4, 0.25 floor is adequate. So what might happen over a period of time as the system stabilizes, the floor on stage 1 might increase. That's my expectation as more data sort of starts coming in. I think this is also part of the RBI kind of providing a glide path, not creating a jerky movement into the expected credit loss based provisioning. And therefore, what will happen between now and then? I think the reduction in the risk weight is also part of that guide path because, as Anil was saying, that banks could actually do one of two things: raise additional capital or create additional provisioning buffer between now and 27 when it kicks in. So that at the bank level also the impact becomes a bit muted. So I think that's the way I see it.
No, very, very interesting points. Anil, you want to comment on the risk weight bit? What kind of stood out to you?
Yeah, I think favorable changes in the risk weight. Overall, basically one negative impact on capital because of ECL and maybe a positive impact on the capital because of risk weight, lower risk weights. Overall, it should be negative on the capital, though the impact will be muted because of these risk weight changes. But maybe few things on the risk weight changes which we found to be maybe interesting was maybe a 75% risk weight on a BBB rated loan, which has been brought down. But generally, we map long-term ratings and short-term ratings. So on a short-term scale, BBB rating category will typically map to A3, on which the risk weight has been kept at 100%, not 75. So if a same corporate is rated BBB on a long term and A3 on short term, so different risk weights will be applicable, 75 and 100. So maybe that's some clarity may be required in the final, maybe whenever regulations come. And one interesting thing which has come this time on the risk weight is the regulator has linked the risk weights based on the default rates of the various rating agencies. So if a rating agency has higher default rates, then the next category of the risk weight applies, or higher risk weight applies, just because the rating agency has a higher default rate. So this is, I think, a really interesting move. We have to see how this pans out, because again, here, this default rates, we will need a clarity that whether short-term default rates will apply or a long-term default rates will apply, because we publish 1-year default rates for 2 years, which is short-term, and 10 years, which is long-term. So which default rates will apply for calculating the risk weights? That is something which will wait for clarity in the final regulations.
In a way, rating agencies themselves being rated.
In fact, if I may quickly add, there is a increased scrutiny of rating agencies. There is a standardization of default. There is disclosure requirements on PDs, which was earlier not there for bank loans, it was there for bonds. So I think RBI has also addressed the governance issues around ECL, both at the level of the bank, but at the level of rating agencies as well.
Oh, very, very interesting. And I think these are points where maybe we needed a little more time. We're coming to it at the end of our conversation. I have to sort of say thank you, but we'll sort of continue talking about this on other platforms. Thanks very much, Harsh and Anil, for joining us with that quick take on these two areas, the ECL and the risk weight circulars from the Reserve Bank of India. Well, it's a wrap on this edition of Bazaar. Chartbusters up next. Stay with us.